Staff Accounting Bulletin 121, more commonly known as SAB 121, was an accounting rule that basically made it so that banks had to recognize Bitcoin and other digital assets as liabilities on their balance sheet. Now, because the banks had to recognize Bitcoin and other digital assets as liabilities under SAB 121, this meant that the banks had to have a corresponding asset to match that liability. So let's say, for example, that a bank had $100 million worth of Bitcoin in custody. This would mean that the bank would have to have $100 million in cash or treasury bonds or some other asset to match that liability. Now, when we look at the banks, the whole business of the bank is to lend money out. So as a bank, you don't really want to have assets sitting there in custody, right? You want to be lending those assets out. So because of the business model of the bank, banks didn't want to hold that corresponding asset to match that liability. They would rather lend that $100 million worth of cash out and try to earn interest on it. A lot of people viewed SAB 121 as not very fair and kind of malicious towards the Bitcoin space, because when you look at traditional assets that banks custody, they don't have to mark these assets on their balance sheet as liabilities. So now that SAB 121 has been repealed, it means that banks don't have to hold that corresponding asset to match that liability. That means that banks are more incentivized to offer Bitcoin custodial services, and that we could see Bitcoin-backed loans coming soon to the commercial banks.